This tutorial has been created to help you prepare your financials for Project Part 3. It is designed to follow up on some of the tutorials that you had in Assignment 12 and to complement the information that's in Chapter 16 as well as Chapters 15 and Chapter 17 in the textbook. What we're going to do in this tutorial is talk through the difference between a single versus a multi-step income statement, or income statements are also called profit and loss statements. We're going to show you a spreadsheet sample, and that will also be available to you to use that same spreadsheet to put your numbers in. We'll review the flow diagrams from the textbook in Chapter 16, specifically the ones that look at the ins and outs for an income statement and the ins and outs for a cash flow statement. And we'll show you an example of what this might look like in a project. So, first thing to point out is that when you put together this financial information, the foundation is very important. And that foundation is actually real numbers that you develop or estimate as effectively as possible. And as those assumptions and estimates change, you want to make the changes to your financial statements accordingly, which is one of the reasons that you want to understand how all of this works. The overall suggested process for preparing your financial forecast is as follows. You should start with a go-to-market plan that includes a timeline. And what I've shown you here is an example of one of those go-to-market plans with a timeline that I used in the previous tutorials. From there, you can then include, if that timeline should ideally include investment amounts and the timing of when you need money to do certain things, and ideally it would just have some kind of discussion as well as to when you might sell what. That then feeds into building up a sales forecast by year, and you'll also need a cost forecast by year based on all of that information. When you put those two together, that allows you to build 3 years worth of profit and loss statements or income statements. And those 3 years of profit and loss statements, in combination with what you had to invest, will allow you to create 3 years of balance sheets. Those balance sheets, the numbers on the balance sheets in combination with the numbers on your profit and loss, can basically create a 3-year cash flow statement. When you put together the cash flow statement, you'll see any times when cash runs out, and when it does, then you know that you're going to need to make some changes to your overall financial model to get it to work. Ultimately, if you have all of these pieces in place and they are done as accurately as possible, it will also help you develop a valuation for your business, and that's something that we're going to be covering later, and it's not a requirement for Project 2 Part 3. Okay, so let's go through and talk about a single step versus a multi-step income statement. What do we mean by that? Well, let's look at the following income statement, which is a single step income statement. And in a single step income statement, you have revenues, and you basically list all of the revenues that the business might have. Then your second category is the expenses. You list all of those expenses. You total your revenues, you total your expenses, you subtract the latter from the former, and you will get net income. Now, that type of way of structuring your income statement has some problems. There's no distinction between operating and non-operating categories, and it turns out that that distinction is very important in terms of understanding how businesses operate. There's also no distinction between variable and fixed expenses. And that becomes very useful because you really want to understand if you increase the number of products that you sell or the number of services that you provide, there should be some kind of a break-even. And so you can't do a break-even analysis unless you separate variable and fixed expenses. And it's also difficult to compare similar businesses. So the type of structure that I recommend that you use for your income statement is called a multi-step income statement. So what it does is it starts off identifying the products that you sell and then subtracts from that the cost of goods sold to generate a gross profit. And those cost of goods sold are also called variable costs, and it allows you to see what is fundamentally happening in the business. You have a different category of expenses, which are your operating expenses, which are your fixed costs. So you want to have that fixed cost separated from the variable costs. And here are some examples of categories that you might use. And in other parts of this tutorial, I'll give you some of those examples also. Now, it's worth pointing out one technicality that you'll see multiple times as we go through it. And that technicality has to do with depreciation. Depreciation is basically the loss in value of something that lasts more than a year. So for example, a machine that you can use for 10 years to produce a product, and then at the end of the 10 years it's worn out, you want 10% of that cost in every year's expenses, not the entire cost. So that's basically that 10% of the initial cost is basically called the depreciation. And it's also, there's other things that work that way that are not physical items, and those things also decrease in value by year, and that decrease in value is called amortization. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So if you don't include depreciation, you do it later, what you will end up with is your operating income will be EBITDA. If you do include depreciation as one of your operating expenses, then your operating income is EBIT, earnings before interest and taxes, but it's not in earnings before interest, taxes, depreciation, and amortization, because those things have already happened. In either way, you end up with operating income. Once you have operating income, you can then calculate the other categories that you see here. I also strongly recommend that you include a percentage column. As we've seen in some of the earlier tutorials, that percentage column helps you understand your business relative to other businesses that are similar, so that you can work out how to manage your business effectively. So when you look at this multi-step versus the single step, the multi-step version of an income statement separates operating and non-operating transactions. It matches revenues with related costs, and it allows comparisons with similar businesses. And one other thing I should point out is that in this class, in order to simplify what you're doing, you can always assume that what you have is a pass-through business, and you don't need to worry about income tax. So go ahead and leave that category out. It'll make things a little bit easier. Let me talk through that system in a slightly different way, and I apologize for the wordiness of this slide, but there are a number of important concepts that are worth repeating, and they're pretty difficult to try to learn. So when you do the multi-step format, there are 4 steps that one typically goes through, and you need to do 3 of those. The first of those steps is revenues minus cost of goods sold equals gross profit. And so all your variable costs should be in cost of goods sold, and that gives you a good starting point. The next step is that you take the gross profit that you got out of step 1, you subtract the fixed operating costs, and you then end up with operating profit. And some of the subcategories for fixed operating costs might be things like advertising and marketing, product development, and facility costs. What do I mean by facility costs? Might be utilities, it might be cost of a computer that you're using, things of that nature. Okay, now some footnotes about gross profit minus fixed operating cost equals operating profits. When you do this, your profit and loss statement should include your salary or the salary to hire someone to do your job if that job is necessary to operate the business. So that salary is typically put in as part of operating costs, but if you are a part of the business and it can't run without you, your cost for being part of that business ought to be in there, because otherwise it doesn't really match other businesses similar to it. And another footnote back to this concept of depreciation is most businesses, depreciation is a part of fixed operating costs. But if you prefer, you can subtract depreciation after calculating operating profit so that your operating profit is actually earnings before interest, taxes, depreciation, and amortization. And if you do it that way, you should show a separate depreciation line after calculating EBITDA so they can later be subtracted to get a correct operating profit, or EBIT. The alternate way of doing this is to show a correct operating profit, which includes depreciation as an operating expense, and then you basically can calculate EBITDA, which you might need for valuation analysis, by adding the depreciation back to the operating profit. So 4 steps in this multi-step process. The third step is you have your operating profit, you subtract your interest expense, and that gets your income before taxes. So there could be some other things that go into this category that is the difference between operating profit and income before taxes. So for example, you could have non-operating expenses. So that could be things such as dividends that you give to others. It could be other things that are just totally not related to how this particular business operates. For example, you might be in a building and you're renting out part of the building. So it's not related to how this business runs, but it is part of what's actually getting reported to the tax man. So that's where it would go. Final step, which you can ignore, is if you have income before taxes, you subtract taxes and you get net income. But in this class, as I mentioned before, you could ignore that step. Okay, so let's go through a spreadsheet example, and I will also provide you this exact spreadsheet so that you can actually look in the cells and see how the calculations are done. So assuming that you have now put together your income statement, it might look something like this. And once you have that in your spreadsheet and you want to start generating your balance sheet and cash flow statement, the first thing you do is you hide the percentage columns. The other thing that you do is you insert a column before year 1 and after the column where you have the categories so that you can put the beginning balance sheet information, which are the things that you are doing before you start the business or at the moment when you start the business. When you do that, your income statement will actually look like this on your computer screen. The other columns after year 1, year 2, and year 3 that have the percentages have been hidden because they're not things that you would use for the balance sheet and cash flow statement. And we've added a column which we've called day 1, which is where we can put the beginning balances. What we will do next with this is we will start to work out what things in that income statement we actually need in order to do our calculations for the balance sheet and cash flow statement. Turns out that there are 2 lines that are important. One of those lines is the net income line, and the other is the depreciation line, because those 2 will affect the balance sheet and the cash flow statement as well. So we're going to take those 2 lines, and just for now we hide other lines to make it really easy to see what we need to do. And what we do as well, so you can see those 2 lines are at the top of our what we're now going to use to build our balance sheet. And we're going to create the different categories or rows that exist in a balance sheet. And you can see what those are. You have assets, and typical subcategories of assets would be things like cash, machinery. And for machinery which lasts multiple years, you're going to have an accumulated depreciation line. The net of the machinery and accumulated depreciation is basically the amount of value that's still left in that machinery. All of that adds up to total assets. Then the other side of the balance sheet will have liabilities in it, and liabilities are things like loans. And it will have a category called equity, and equity is things like how much you put in or others put in originally to start the business. So, and then retained earnings is how much profit the business made that hasn't been distributed out and is still in the business to help pay for other costs. And each of those can then be totaled, and you end up with total liabilities and equity, and total liabilities and equity have to equal total assets. So now that you've set up the balance sheet, The next thing to do is to add your beginning balances. So those are what values will you have for each of the items I just mentioned during the first day when you open up. And here is an example. Notice that the total assets equals the total liability and equity. The business is starting out with $20,000 worth of cash and $10,000 worth of machinery for a total of $30,000. The $30,000 came from $25,000 loan and $5,000 that the owner put in. So that is what a balance sheet might look like for your business when you start out. Once you have the beginning balances in, the next thing you do is use the following formulas to calculate what's going to happen to the balance sheet at the end of each year. So the income statement is a summary of the things that happen during the year, and now you're going to use them to identify what happened in year one between day one and the end of year one, and then what happened in year two between the end of year one and the end of year two, and then what happened in year three between the end of year two and the end of year three. So let's go through that. Retained earnings in the balance sheet is going to be last year's retained earnings plus this year's net income. You might have more loans or fewer loans, paying back loans, so that would change liabilities. You might have more owner investment, or owners might take out some of their investment. That would change the equity, the owner's contribution part of the balance sheet. So once you do that and you make those changes, you can then calculate total liability and equity. So you start the balance sheet from the bottom up. So here's retained earnings have now been put in, and you can see where those came from and the income statement. And you can see that owner's contribution and loans have stayed the same in this particular example. When you then do that totaling, you get the total liability and equity. And the next thing you do is, because a balance sheet has to balance, that total liability and equity has to be the same as the total assets. So you copy those values to total assets as I've shown here. So you can see that those now match for each of the 3 years as well as on day one. Next, what you do is you put the accumulated depreciation in the line right above total assets. The accumulated depreciation is basically the depreciation for each year added to the depreciation that was there the previous year. So you can see here we have the machinery. It's being depreciated on a straight line basis over 5 years, which means 1/5 of $10,000 is $2,000 per year. That's what that looks like. Then you can work out what might happen in terms of buying more machinery or other equipment or anything. And if you do, in this particular case, that's not going to change. But then what you can do is, once you have that number in there, you can basically work out, based on the fact that the total has to be of cash plus machinery plus accumulated depreciation has to equal total assets. You can work backwards and calculate the amount of cash that's left in the business. So you should now understand how to put together a balance sheet from the information that you have in terms of investments, from the net income in the business, and any depreciation that might occur during the year. So next thing we need to do is we need to create the cash flow statement. The cash flow statement is not too complex if you have the profit and loss statement and the balance sheet and you understand what you need to do. Basically, what you're doing is you're moving things from one category to another. So you can see what I've done here is that the same things that were identified in other places have simply moved. Now you'll notice I called it net income in one place and I called it net profit in the other. That should be understood the same way. Depreciation, that came from the income statement. When you take those two and you add them in the way in which I've shown you, that gives you the cash from operations. On day one, there was cash that was used for several things and there was cash that came in. on day one, $30,000 came in, which was $25,000 of loans, $5,000 worth of owner's contribution. And of the $30,000, 10 was spent on asset purchases, which left a change in cash on day one. The cash increased by $20,000. In the subsequent years, there were no asset purchases, there were no loans, there were no owner contributions in this particular example. Your example might be different. And so you can see then what the change in cash was in those years. It was basically the cash generated by operations. Now, once you know that, then you can work out from the beginning cash what the ending cash is, and that's shown here as well. So once you have those numbers and you get that ending cash, to check to make sure that you've done all of your calculations correctly, the ending cash on your cash flow statement should equal the ending cash in each of the years in your balance sheet. That's a very key thing to making it all work. Now, conceptually, let's go back to chapter 17, and in chapter 17, they have some very good equations to explain how some of this works. So, for example, here's the little flow diagram that shows income statement calculations. You start with revenues. You subtract the cost of revenues, which is also called the cost of goods sold. That's that step one, which gets you your gross profit. Once you have your gross profit, you subtract out your operating expenses, and operating expenses can be in a number of categories, such as sales and marketing expenses, general and administrative expenses, research and development expenses, and depreciation and amortization expenses. Once you have your gross profit and subtract your operating expenses, what you end up with is your operating profit, EBIT, earnings before interest and taxes. From that, you then identify any interest expense, or you would subtract interest expense. If you had interest income, it would actually get added. So once you've subtracted your interest expense, you end up with your pre-tax profit. Pre-tax profit minus income tax expense equals net profit. Now, in terms of cash flow calculations, the cash flow calculations are cash in minus cash out equals change in cash. So you can receive cash from sales, you pay it out to suppliers, salaries, labor, contractors, taxes, interest, etc., which then identifies the amount of cash that you get from your operations. And remember that cash from operations line in the sample spreadsheet, or go back and look at it. Then from your cash from operations, you could end up with more cash if you sold assets, if you got more loans, i.e. new debt, if you got more investment from outsiders, i.e. new equity, and that then identifies how much cash you have before you disperse any cash. Finally, what you can do is you can use the cash that you have in the business to purchase assets, to pay off debt, to buy back stock from stockholders, or to pay out dividends to stockholders. And the result is your net change in cash. Finally, what we want to do in this tutorial is show you an example. And I'm going to go through this example pretty quickly, so you may want to stop and understand each part of it. So this is the same example that I showed you for the go-to-market plan. And in this particular example, we've also used it in a previous tutorial, and I showed you the sales forecast. So here's the sales forecast that generated the total revenues. From that sales forecast, this student then generated an income statement, and you'll see that this income statement follows the template pretty exactly. So you then see this particular income statement, and this income statement was then used to generate the balance sheet and the cash flow forecast. So here is the balance sheet for this business, and here is the cash flow for this business. And this student worked it through completely, got all the right assumptions in all the right places, and the ending cash equals the cash on the balance sheet. So the cash flow statement and the balance sheet match. The balance sheet, total assets, and match equals total liabilities and equity for each of the years. And this is really what we're trying to achieve. Now, this is a pretty challenging thing to do, to get everything to come out this way. What I want to point out is here are related materials that can help you with this. First off, the textbook, and this should really say chapter 17 rather than chapter 16, but it is the chapter that has the various examples in it. So look at textbook chapter 17. Also, go through the tutorials for assignment 12. So there are 4 tutorials for assignment 12, and it's worth reviewing each of those 4 tutorials. Then class on Thursday, April 9th will provide some further demonstrations of how this works and gives a good opportunity for questions and answers. And if you still have questions, which many of you will, because this is a very difficult topic, feel free to email me and I'll be happy to work through things. So that's it for now. Good luck, and let me know if you need anything further.